Most people think you need to be a millionaire to retire comfortably. The average American household spends about $5,000 every single month, which works out to around $60,000 a year, just to keep up with basic living expenses. And here's the myth. If you asked a room full of people how much money they'd need invested to cover that with dividends, almost all of them would say $1 million. But here's the shocking truth. If you tried to live off the S&P 500's dividends alone, you wouldn't just need $1 million, you'd need closer to $5 million. Yeah, $5 million, just to replace the same income most families need to survive today. Now that sounds discouraging, right? But what if I told you that you don't need millions? What if I told you that you could start with as little as $1,000 and begin building a Fidelity Index Fund portfolio that, over time, grows into a powerful income machine, one that covers your living expenses month after month without you ever selling a single share? That's exactly what we're diving into today. In this video, I'm going to show you the lowest amount you actually need to live off Fidelity Index Funds. And I promise, it's probably less than you spent on your last vacation. Here's how we'll do it. First, we'll break down the biggest mistake people make when they start dividend investing and why chasing the highest yields is often a trap. Then, I'll walk you through the simple 3-part formula that separates a weak portfolio from one that can truly pay you for life. After that, I'll reveal 5 carefully chosen Fidelity Index Funds that balance yield, dividend growth, and appreciation, not the same funds you see everywhere, but ones that work together as a complete strategy. And finally, we'll run the numbers. I'll show you how much you'd need invested to generate a reliable $60,000 in annual income. And even more exciting, how you can reach that same goal up to 10 years faster if you structure things the right way. So, if you've ever wondered how much you really need to stop working and start living off your portfolio, or if you thought dividend investing was only for people with 7 figures in the bank, stick around. By the end of this video, you'll see how much smaller that number actually is and how you can start building toward it today. Why index funds are smarter than other options. When most people think about getting rich, they picture rental properties, picking hot stocks, or maybe even throwing money into crypto and hoping it skyrockets. Sure, these can work, but they also come with stress, risk, and constant effort. Real estate needs huge down payments, repairs, and dealing with tenants. Stock picking feels exciting until one bad earnings report wipes out years of gains. And crypto? That's basically a roller coaster with no seatbelt. Now compare all of that chaos to index funds. Index funds are the boring, steady, reliable friend that doesn't make headlines, but quietly gets the job done. They're low cost, automatically diversified, and incredibly simple. Instead of betting on one company, you instantly own hundreds, even thousands. That spreads the risk and smooths out the bumps. You don't need to check earnings reports every quarter. You don't need to wake up at 3 a.m. worried about what a celebrity tweeted about Bitcoin. With index funds, you buy, you hold, and you let time do the heavy lifting. No, it won't make you rich overnight. But for building serious long-term wealth and creating a reliable income, index funds are the smarter tool. Now, before we jump into the exact funds I picked, we need to talk about the biggest mistake I see investors make when they first hear the word dividends. Because if you fall into this trap, it doesn't matter what you invest in, you'll always end up disappointed. The mistake is chasing the highest yield you can find. It sounds logical at first. You look at a list of funds, one of them is paying a 7% or even 10% dividend, and you think, well, that's perfect. Why would I settle for 2% when I can get 5 times as much? But here's the reality. Those sky-high yields are usually a big, flashing warning sign. When a fund or a company is paying unusually high dividends, it's almost always because the market doesn't trust it to grow. In many cases, the share price is stagnant, or worse, it's falling. And the only reason investors stick around is because they're being compensated with a bigger check today. That's not income you can rely on, it's a ticking time bomb. So instead of focusing only on yield, here's the smarter way to think about it. Focus on total return. Total return is made up of 3 things: the dividend yield you're earning today, the growth of those dividends over time, and the appreciation appreciation of the share price itself. And that's exactly the mindset I used to choose the Fidelity funds we'll cover in this video. I didn't just ask, who's paying the biggest check right now? I asked, which funds strike the balance between healthy starting yield, strong dividend growth, and long-term appreciation? Because once you put those three together, you stop chasing quick wins and start building a system that pays you reliably for life. So if chasing the highest yield doesn't work, then what does? How do you actually build a portfolio that can grow, compound, and one day cover all your living expenses without you ever selling a single share? It comes down to a simple three-part formula. Think of it as the engine behind true dividend investing. Dividend yield plus dividend growth plus share price appreciation. Let's break this down. First, you need a reliable dividend yield. This is your foundation. Dividend yield provides your starting income, the steady cash flow you earn simply by holding the fund. Second, and this is the part most people overlook, you need strong dividend growth. A payout growing 10 to 15% a year doubles every few years. And that compounding is far more powerful than a flat 5% yield. And third, you want share price appreciation. Because at the end of the day, you don't just want to collect dividends, you want your underlying portfolio to grow in value too. When all three work together, you're not just earning dividends, you're creating an income engine that scales with you. And here's the best part. You don't need to stock pick to get it. Fidelity already has index funds designed to deliver steady yields, strong dividend growth, and long-term appreciation. So now that you understand the formula, let's put it into action. I'll walk you through the 5 Fidelity Index Funds I've chosen that work together as a complete income machine. I've handpicked 5 Fidelity Index Funds that check all 3 boxes. They pay a healthy dividend, they've shown strong dividend growth, and they've delivered solid long-term appreciation. And when you combine them, you get a balanced portfolio that can grow into a reliable income engine. Let's break them down one by one. Number 1 is Fidelity Total Market Index Fund, FSKAX. This is our core growth engine. FSKAX gives you exposure to the entire US stock market, large caps, mid caps, and small caps. That means instant diversification at one of the lowest costs you'll ever find. The yield is modest, right around 1%, but that's not the point here. FSKAX shines because it combines steady dividends with long-term appreciation. Over decades, the total US market has delivered returns north of 9% annually. And that's the power we want working in the background. Think of FSKAX as the bedrock of this portfolio, the piece that grows quietly while others handle more of the income duty. Number 2 is Fidelity Mid-Cap Index Fund, FSMDX. Now let's add some fuel to the fire with mid-cap stocks. FSMDX is the dividend growth booster in this portfolio. Mid-caps are often in that sweet spot, not small, risky startups, but not yet the slow-moving giants either. Historically, this group has shown stronger dividend growth than large caps, while still delivering solid appreciation. FSMDX pays a yield around 1.5%, but more importantly, its dividends have grown at double-digit rates over the past decade. That compounding growth is what makes FSMDX such an important piece of the puzzle. Number 3 is Fidelity High Dividend ETF, FDVV. Next up is the income tilt. FDVV is built specifically to hold large and mid-cap US companies with strong dividend-paying track records. This is where we start to see higher payouts. FDVV currently yields around 3.1%, which instantly boosts the cash flow in our portfolio. But unlike the risky high-yield funds we talked about earlier, FDVV focuses on quality companies, businesses that can sustain and even grow those dividends. This fund helps us bridge the gap between long-term growth and income you can actually spend. Number 4 is Fidelity MSCI Real Estate ETF, FREL. Now, we need real estate. Why? because real estate investment trusts, or REITs, are legally required to pay out most of their earnings as dividends. That makes them a natural source of higher income in any dividend strategy. FAREL gives you exposure to a broad mix of US real estate companies, from office buildings to cell towers to storage facilities. The current yield sits around 3.5%, and it also acts as an inflation hedge. When costs rise, rents and property values often rise too, which helps protect your purchasing power. FREL brings stability and consistent income into the mix. Number 5 is Fidelity International High Dividend ETF, FID. Finally, we round things out with global diversification. US stocks are powerful, but relying on a single country for all of your dividends isn't the best idea. FIDI focuses on international high dividend companies, giving you exposure to developed markets outside the US. The yield here is the highest of the group, hovering around 4.7% to 5%. That extra boost of income helps balance out the lower yields from funds like FSKAX, while also reducing your dependence on the US economy alone. Plus, many international companies have strong dividend traditions, often paying out a higher percentage of their profits to shareholders. All right, now that we've got our 5 Fidelity funds in place, the big question is, how much money do you actually need in this portfolio to live off the dividends? Let's run the numbers. If we take the weighted average yield across these 5 funds, we land right around 2.45%. That's significantly higher than the S&P 500's 1.1% payout, but still low enough to keep this portfolio balanced, safe and growing. So what does that mean in real life? Let's say your goal is the same as the average American family, about $5,000 a month or $60,000 a year in income. To earn that amount at a 2.45% yield, you'd need a portfolio of roughly $2.45 million. Now, before you click away thinking, well, I'll never have that much money, let's put it in perspective. First, let's compare it to the S&P 500. If you invested in the S&P 500 through an index like Fidelity's FXAIX, which pays about 1.16%, you'd need over $5 million invested just to earn the same $60,000 a year. That's literally double the amount required. So this portfolio already cuts that mountain of money in half. Let me give you a quick slider to show the difference yields can make. At a 2.0% yield, you'd need about $3 million. At 2.5%, you'd need about $2.4 million. At 3.0%, it drops to $2 million. At 3.5%, just $1.7 million. So the more you tilt toward income, the less capital you need. But at this point, you might be thinking, okay, I get it. Index funds are great. Dividends grow. Compounding works. But how long will it really take me to hit that $5,000 a month goal? The truth is, it depends on how much you can invest and how consistently you stick with it. So let's look at 2 very different scenarios. Scenario 1, the small start. Let's say you only have $1,000 to begin with. That's it. No inheritance, no 6-figure salary, just a modest starting point that almost anyone can realistically pull together. From there, you commit to adding just $1 a day, about $30 a month, or $360 a year. In the first year, your portfolio might only grow to around $1,400. Not life-changing, but it's a start. By year 10, your total contributions are less than $5,000. But the portfolio could already be worth close to $10,000, nearly double your money. Fast forward to 20 years, and those steady daily contributions of just $1 add up to about $8,000 invested. But thanks to compounding, your portfolio could be worth $45,000 or more. And here's the magic. By year 30, that same slow and steady approach turns into a portfolio worth well over $400,000. At that point, your dividends alone could be paying you more than $6,000 a month. From just $1,000 to start, plus $1 a day. That's the power of patience, consistency, and compounding working in your favor. Scenario 2, the accelerated path. Now let's say you can push a little harder. Instead of starting with $1,000, you begin with $20,000. And instead of $1 a day, you commit to $20 a day, about $600 a month. Here's how that changes everything. After just 1 year, your portfolio is already pushing $30,000. By year 10, you're sitting at nearly $185,000. And by year 20, your total contributions are about $93,000. But your portfolio has ballooned to almost $915,000. That's nearly $1 million in just 2 decades, without extreme sacrifices, without stock picking, and without betting everything on crypto moonshots. And the best part? At that level, your dividends alone would generate around $68,000 a year, or more than $5,700 a month, enough to fully cover the average household's living expenses. So, what does that mean? It means you could hit financial freedom nearly 10 years faster than the slow and steady approach, simply by starting bigger and staying consistent. So, let's pull it all together. And if you want to take this strategy even further, here's what to do next. Click on the video on your screen right now, where I'll show you how to structure your portfolio so you actually get paid every single month, starting as soon as next month.